Thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We discuss what's impacting mortgage rates on a daily basis, whether it might come from headline news, economic calendar, or geopolitical. But sometimes it can really get confusing out there when the market sentiment changes and good news is now bad news, and people may not understand what's going on out there. We try to jump right into it and kind of give the explanations of what's going on there, what's the thoughts of the investors that are impacting markets here, like mortgage-backed securities is what's impacting mortgage rates, as well as the stock market and treasuries and everything else. So we try to get into those and give you a little insight as to what's going on and how a little bit more information on it, so that way you have a little bit more education on there. A little bit about myself is I am a loan officer. I work with a national lender. We do loans in all 50 states, so I'd love to be able to help you out if you have any mortgage needs, whether if it's a refinance or purchase. Um, but more than that, we'd like to be a resource. So if you guys got any questions about anything, we can be of any assistance, please feel free to reach out. Without further ado, we'll jump right into the economic calendar. And today is the big day, and that is inflation data. And it was, well, there's no prettier word, but say it is ugly. Um, we'll start with the first item here. This is the core CPI month over month. And the core is when you exclude food and energy. And April, it rose 0.6%. Forecast was counted for 0.5%. And it exceeded that. It kept that same pace at 0.6%. So I'm going to go to annual. It went from 6.2%. Forecast was counted for a dip down to 5.9. It did dip a little bit to 6%. And then we got the headline number, the consumer price index, the month over month. Went from 0.3% in April. Forecast counted for uptick of 0.7, and it went to 1%. So its year over year went from 8.3% with the forecast of remaining unchanged to 8.6%. So these are all pretty ugly. The only one that's kind of, everything's been pretty much came in over the forecast. However, the only one that went down is, of course, the core um, went on year over year dropped. But again, it's still higher than what the forecasts were. So this is a pretty ugly looking day for us. This is the data that we were looking for. And of course, the investors were hoping that we were peaking. And this is basically shows that we may not have yet peaked yet. So as we go into the summertime, we could see things get a little bit worse, perhaps even in the fall as well. Let's go on. We'll get back to that a little bit more. Um, and then last but not least, we got the consumer and sentiment. Uh, this was at 58.4 back in May. Forecast was supposed to be a slight dip to 58, and it had a pretty major dip at to 50.2 in June. So people aren't feeling as rosy about things now. Of course, we're looking at food prices. We're looking at gasoline prices. Price per barrel of oil now is up to $121, and we're seeing that at the gas pumps. Food prices are rising dramatically, and this is really pinching a lot of people. We're at summertime, so people like to take vacations, but may not be able to because air flights are more expensive, hotels are more expensive. A lot of these items are a lot too expensive for people to go out on a normal basis. And what does we talk about the inflation and what the investors thinking? Well, Fed is being heavily criticized. They believe that they were behind the eight ball and kept talking about transitory and kind of be patient, but obviously we're not seeing that not really as transitory as they had proclaimed. Um, Basically, that they're going to have to tighten up. I mean, it looks like this could probably be more. They're going to have to get tighter than what they currently are. So we're looking at next week, Fed meeting next week. We're expecting 50 basis points and then probably another 50 basis points. There's thought that perhaps they might pause, but they may keep going, or maybe they even raise it from 50 basis points to higher. It's you never know. I'm sure that can't be necessarily off the table when we see inflation as persistent as it's been, and that's the Fed's biggest priority right now is try to tame inflation and bring inflation back down. Now, to look at as a result, mortgage-backed securities are way down, and same thing with stocks. Today, it's really kind of a mess here because it's been going up and down quite a bit today. We were actually down at 105 basis points. And what does this mean? Well, a basis point is 100 basis points equals 1 point. So right now we're down to about 77 basis points, so we're down approximately 3/4 of a point. So what that means is that no point loan you were quoted yesterday now could cost you 1 point or 3/4 of a point. Right now. So right now it'll be a 3/4 of a point, but depending on where lenders are at, because sometimes they will be with this type of volatility, lenders could be a little slow to react in terms of improving. So if they went to 1 point, they might have left the pricing at that and wait till later in the day to see where things are at if they decide to show a price improvement. For example, if this pulled back to maybe closing down 50 basis points. So they may be a little slow because they're going to be a little bit more conservative and don't want to lose money. So again, mortgage rates are had pretty. This is a dramatic effect on mortgage rates today. So we haven't seen this type of a drop for quite a while here, and this just shows you the volatility as how it came down, these up a little bit up and down here. So we're not the lows quite yet, but we are still pretty down, still down pretty far here. And let's look at yields. Yields, of course, adding to the pressure. We're up at 3.15 now. That was a pretty big spike. That's the new high we've seen in a while. We had the previous high wasn't that, the previous one wasn't quite that high. Where was it? Let me see where it was. Well, actually, we were pretty close back in May. I guess we did kind of spike up that way pretty close and then dip back down again. So we'll see if that reached there. So my apologies. I didn't think we reached quite that high, but yeah, we did pretty much come pretty close to that. It was at doesn't really necessarily say. Sorry about that. But anyways, let's move on. Lastly, we'll take a look at the average rate for conforming loan limits, and that is the 15 years at 4.88, and the 30-year is at 5.55. Now these are delayed by a day, so Monday could be a lot worse than this according to this, due to the pretty big spike. These are kind of delayed by a day, this data, and they do have points built into them. So if you guys would like a rate quote, please feel free to reach out. We are here to help you guys out. We'd be more happy to help you. But if you guys like these videos, please help us out and smash that like button. We greatly appreciate any help you guys can help lend to the channel, get us a little bit more exposure. We do appreciate you guys, and thank you very much for watching. And we look forward to see you guys on Monday. Take care. Bye-bye.